Hello YouTube, this is Steven with On My Way to FIRE, a channel about early retirement and all things investing. And in today's video topic, I want to cover 401k breakthroughs. And these are going to be slightly specific to me, and I'm going to give some general information as well. So I hope you enjoy it. So according to a 2023 Bureau of Labor Statistics survey, approximately 73% of workers have access to a 401k plan, and about 56% participate. When you narrow this down to management professional workers, about 85% have access to a 401k plan and about 73% participate. So it is a majority, but you would expect it to be maybe a little higher as time goes on. Maybe if I can get more survey information that's a little bit more current for a future video, I'll indicate the difference. But that does go to show you that more than half people are participating when offered. But it's a difficult road to get started because you have to really look at your budget and see how much you can afford to contribute. So the main benefit of the 401k is it's tax deferred, meaning that income that you contribute comes off the top and lowers your taxable income for the year. So more of your money goes to work in your investment. But like I said, it's a mental hurdle to get your budget under order and to find that right sweet spot to where you can contribute without feeling constrained in your budget. So just getting started is probably, in my opinion, somewhere between 75 and 90% of the hardest work, just getting that process going. And in some aspects, you might even want to go with a lower contribution rate just to get used to it and see how your budget does. And so the main motivation for most people is going to be to capture that employer match. And typically that's going to be somewhere between the first 5 and 6%. You'll get a certain percentage match against that. So for my company, it's somewhere around 50% of the first 6%. Other companies may do 100%. It really just depends. Even if you don't get a match though, you still get that tax deferred status on the money that you contribute. So that's the main motivating factor. Think of it as, like a nice little bump that you're getting an automatic, bonus within the 401k just to get started. Now, a popular misconception is you need to understand the stock market in order to do well in a 401k. And that's just simply not true. Just contributing, mainly what you're buying are mutual funds. And for a lot of it, it'll default into the general S&P 500 or a Vanguard Wellington fund that's very balanced. So you want to look at those details, maybe Google it a little bit, do a little bit of AI review possibly, and get a sense of what it's investing in. And, consider, your age and your risk level. I did another video on that. You can look that up to see if that's, or really risk tolerance, see if that applies to you. Now, another big part of it is understanding that the market goes up and the market goes down. And it tends to stay in a range back and forth for a period of time, but it is common to have mini corrections, which are less than 10%, a full correction 10% or more, or a bear market where it goes down more than 20%. So that's just the way that the stock market works. It's momentum based. There's a lot of algorithmic trading now. There's a lot of options trading. There's a lot of leverage in the market. You really want to ignore all that and just keep your automated process going, contributing on each paycheck. And you don't want to overthink it. Staying in the market and allowing time to build is your biggest asset. So keep it automated, and whenever possible, try to increase that percentage. So say you get a raise, try to make sure that you allocate maybe an extra 1 or 2% and see how you do on those next checks. But just keep in mind, it can take 1 to 2 pay periods for that to show up. All right, and another breakthrough in the 401k is think in decades and not in years. In the beginning, I thought it wasn't working, and I just continually see my account going down. And during that time, it was buying shares at a really attractive price, but I didn't really know it relative to the market at that time because that was over 10 years ago. So if I could go back, I do wish I could have contributed more, but at the same time, that's what my budget allowed. And I didn't want to stress myself out thinking I didn't have money to cover my monthly expenses. But if I really did the math and dug into what the share price was at the time for the different funds that I purchased, I bet my return is probably well over 100% for those first year or two of contributions. So it makes a huge difference once you get past 10 years of what that prior contribution was. Even if it was small, it makes a huge difference in getting the foundation set for your account. And when I talk about automation, that means buying in good markets and bad markets. You're not concerned that the market went down 5% within a week or that it went up 10%. You're just keeping it consistent and keep that momentum building to where you're constantly adding to your share count. So the dollar amount is what greets you when you first log into the website, and that can either make you happy or make you mad to see it down. But the real long-term perspective on it is seeing that your share count grows month after month, and that's really the big progress, because what ends up happening is every quarter you generally get dividends and in some cases capital gains from your mutual funds, and they will continue to grow over time. And because you have more shares, it keeps compounding faster and faster as the years go by. But those first probably 1 to 5 years are probably the slowest period where you don't really see the growth that you might be expecting. You know, a number that people like to throw out is somewhere around 7%. You know, if you average it out, but you're going to have some years where you make over 20% and some years where you're negative. So that's how that works. But I think one, you know, main thing that a lot of people always want to throw out there is, well, I want to beat the market. And if that S&P 500 returns somewhere around 8% for a year, you feel that you should make 10% or more because, you know, you have more knowledge or you contributed more or whatever your reasoning is. But that's really the wrong way to go about it. You know, it's good to have a goal, but at the same time, just being the market is the best course. Just buying the market as, you know, your intervals go on and your paycheck periods progress, you know, you're contributing and participating in the market momentum. So don't let it get to you that the markets, you return this or that the prior year or the forecast for the next year. You're just about building share count and getting that account created, and whenever possible, increasing those contributions so that you know, have a larger base of shares as time goes on. So to give you perspective on this, $10,000 invested with a 7% return after 10 years becomes $19,672. After 20 years, it becomes $38,697. And after 30 years, becomes $76,123. So you can think of this a couple different ways. Whether you can only contribute to part of that amount, you know, reduce it. If you can only do 2,500, do 25% of those numbers. If you can do the whole amount, do the 10,000. But, you know, the way I think of it is I'm contributing at an extremely high rate, over 30% consistently throughout the year, because the 401k limit is based on the calendar year. So you can't go back and, you know, retroactively add once, you know, the year closes off. So I have to, you know, keep it consistent so that the contributions are pretty much equal and stay high throughout the year so I can hit that limit. But that's not really the, what would I say, the only way to go about it. You know, when possible, I increase it, and there's times during the year where I drop it. So, you know, it really just depends on my budget. So, you know, keep that in mind. When you're increasing your contribution rate, it doesn't have to be forever. And if it doesn't work for you, you know, lower it back down. But those numbers are telling. You know, it takes about 10 years to get, you know, a doubling of your account. But after 20 years, it's 4 times. And after 30 years, it's almost 8 times, 7.5. So, you know, whether you capture a little bit extra or really go for it, you know, it makes a huge difference in, you know, getting that percentage increased. And keep in mind, you're saving on your taxes. But, you know, the hardest part about it is it's a long-term perspective and a delayed gratification where you don't have access to that money until much later in life. So keep it all in perspective to your situation and see what works best for you. So the last part I'll leave you with is, you know, portfolio growth when it outpaces the current year's contribution. So if I can contribute, you know, somewhere around 20,000 and the account grows 25 or 30,000, that's a huge sign to where you've really broken through and that foundation was set in prior years. And it's an amazing feeling when it happens. And I've gotten pretty close, but I don't think I've actually had it happen yet. So I'm going to go back and look at my numbers and see. But, you know, that's just a good feeling to know that things are working in your favor. So I hope you enjoyed the video, got a little something out of it. If you did, please give me a like and subscribe, and we'll see you in the next video. Thanks.